When planning retirement finances, navigating Social Security rules can feel overwhelming, especially regarding the earnings limit. If you are below full retirement age and receiving Social Security benefits, your earnings can impact the amount of your payments. But here's the good news: specific income sources are excluded from these limits, meaning you might have more financial freedom than you thought. What is the Social Security earnings limit? The Social Security earnings limit determines how much you can earn from work before your monthly benefits are reduced. This rule applies if you claim Social Security before reaching your full retirement age, FRA. For 2025, the annual earnings limit is $23,400 if you're under FRA for the entire year. However, in the year you reach FRA, the limit increases significantly, $62,160, and only applies to the months before you hit FRA. After reaching FRA, there is no earnings limit. When you exceed the earnings cap, Social Security deducts $1 from your benefits for every $2 you earn above the limit. It's crucial to note that these reductions aren't permanent. Once you reach FRA, your benefit is recalculated and the deductions may be partially restored. Income sources excluded from the earnings limit. One key feature of the Social Security earnings limit is that it only applies to earned income, such as wages from a job or net earnings from self-employment. Other types of income, including various retirement and financial sources, are excluded. Here are the main categories of income that don't count toward the limit. Pensions. Your pension income from a company or government job doesn't fall under earned income. This means whether it's a monthly payout or a lump sum, you can rest assured that your pension won't reduce your Social Security benefits, providing a sense of relief and security. 401k and IRA distributions. Withdrawals from a retirement savings account, such as a 401k or IRA, are excluded from the earnings limit. This rule applies to required minimum distributions, RMDs, and any extra withdrawals you might take to supplement your income. Unemployment benefits. These payments are not considered earned income if you're receiving unemployment benefits while collecting Social Security. They won't reduce your Social Security check under the earnings limit rules. Capital gains and investment income. Proceeds from selling stocks, real estate, or other investments, along with dividends or interest income, are not part of earned income. Financial gains and passive income sources are entirely excluded from the earnings cap calculation. Annuities and non-taxable income. Income streams from fixed or variable annuities, as well as non-taxable income like municipal bond interest, are excluded from the Social Security earnings limit equation. Non-taxable income refers to income that is not subject to income tax. For example, if you receive interest from municipal bonds, that income is typically not subject to federal income tax and is therefore not part of your earned income for Social Security purposes. How this impacts retirees. Understanding these exclusions can give retirees more flexibility and reassurance when planning their finances. For example, if you've retired but started claiming Social Security early, you can rely on funds from pensions, retirement accounts, or investments without worrying about reducing your benefits. On the other hand, if you're still working or considering part-time employment, it's essential to track your earnings to avoid surpassing the limit. Tips for navigating these rules: consult a financial planner. A financial advisor can ensure you're taking advantage of these exclusions while structuring your finances tax efficiently. They can tailor strategies that align with your retirement goals. Monitor earned income. If you're still working, keep an eye on how much you earn from employment to avoid crossing the Social Security earnings limit. Time withdrawals strategically. If you're tapping into retirement savings like a 401k or IRA, ensure those distributions align with broader financial goals. Because these don't count toward the earnings cap, they can be a great way to supplement income early in retirement. Why it matters. Retirees often worry about inadvertently reducing their Social Security benefits due to the earnings limit. By understanding what counts as income and what doesn't, you can make smarter financial decisions, avoid unnecessary reductions, and make the most of your retirement benefits. The exclusions for pensions, retirement account withdrawals, and unemployment benefits make creating a sustainable income plan easier while securing the benefits you deserve. Are you factoring in the Social Security earnings limit when planning your retirement income, or are you overestimating how much your earnings might reduce your benefits? Are you factoring in the Social Security earnings limit when planning your retirement income, or are you overestimating how much your earnings might reduce your benefits? Could diversifying your income from excluded sources like pensions or investment gains help you maximize your Social Security payments?